Most traders think this is a breakout, but this is where smart money sets the trap. Let's start from the left side of the chart. We clearly see a buy-side liquidity sweep. Price runs above previous highs and takes out resting buy stops. This is not real bullish strength. This is engineered liquidity. Institutions need liquidity to enter large positions, and buy-side liquidity above highs is the perfect fuel. After the sweep, price doesn't continue higher. Instead, the market slowly starts moving down. Then we get something important: a lower time frame break of structure, LTF BOS, to the downside. This confirms that the internal order flow has shifted bearish. Now our bias changes. After a liquidity sweep followed by a bearish BOS, we are no longer looking for buys. We are now looking for a short opportunity. So what do we do next? We mark the area where we expect price to react from. That zone is the mitigated order block. What does mitigated mean? A mitigated order block is a previously used institutional supply zone where price has already partially returned before. It represents an area where sell orders were active and may still contain unfilled institutional interest. Since the market showed bearish intent after the liquidity sweep and BOS, this order block becomes our high probability shorting zone. Now we wait. We don't chase price, we let the market come back to our area. As price retraces upward, we observe the reaction carefully. When price reaches our order block, something interesting happens. The market breaks slightly above the zone, takes additional buy-side liquidity, and then quickly rejects back inside the order block. This is critical. That quick move above, an immediate return, tells us buy-side liquidity has been collected. It's a manipulation, not strength. Now ask yourself, if buy-side liquidity is already taken, what's next? The market's objective shifts to sell-side liquidity. And this makes sense because before price reached our zone, it created a major inducement structure on the way down. Major inducement is external liquidity engineered to attract traders into the wrong direction. It builds expectations, creates equal highs or obvious levels, and encourages breakout entries, only to reverse later. So after collecting buy-side liquidity inside our order block, the market now has fuel to move lower, targeting sell-side liquidity, resting below the lows. That is our target. But we never enter blindly. We wait for confirmation inside the order block, such as bearish rejection, lower time frame shift, or strong displacement candle to the downside. Once confirmation is present, we execute. Entry inside the mitigated order block after confirmation. Stop loss, placed above the previous wick high beyond the liquidity grab with safe buffer. Target, sell-side liquidity below the lows. This creates a clean risk-to-reward setup aligned with liquidity theory and institutional behavior. But none of this matters without proper risk management. Risk only a small percentage per trade. Never over-leverage. Protect capital first, profits come second, because consistency is not built on one big trade. It's built on discipline, structure, and controlled risk. Liquidity sweep gives the signal, structure gives direction, order block gives location, inducement gives confirmation, risk management gives survival. If you want deeper breakdowns like this, watch the next video where we go further into inducement models and liquidity mapping. Trade smart, trade structured.